All right, well, we will make do with what we have for the moment. All right. So everybody can see and here we are. Look at the jump in the VIX, right? 14 up to 16. Very cool. Silver, gold, not doing so good. Apple's always doing the samples, always good. The dollar topped out 102, whatever. See this is where it's, see, that's why I like these things. I forgot what they call pivot points. I like these pivot point charts, they're good. So the dollar topped out right where you think it would top out. Oil, though, failed everything. Oil failed its second support level, so that's very bad for oil. And where'd we end up on that one? Trade, active trader, that's where we are. Yeah, well, that's bullshit because, well, the profit and loss of the day. So in other words, before the day, we were in bad shape. And so so for today, they count the profit as being from here to here, but realistically, we entered around, I think the average was like, was it 80.50 or 81? It was not bad. It was like the average was right around 81, and then it went the wrong way again yesterday, and I just held on to it, and fortunately we came back. It's only up like a couple of thousand after that whole ordeal, but that ordeal was very nasty. It went very far against us for a while. But you know, on the whole, what you do when this is happening, well, you can't see a longer thing, but you know, it goes against you. You double down when you think, you know, here's 82, right? So you double down, then it goes down a bit, and then you know, when you make $1, you remove what you just added, and you've now gained $1. So in other words, if you start shorting at 80, and it goes to 82, and I put in and I double down, right? So now my average is between 80 and 82 is 81. So when it gets back to 81, it doesn't even have to get back to 81 though. But if I'm, you know, if it comes back $1, that makes my new basis 81. That's how you do it. But you've got to remember to take the money off. You can't just keep doubling down and doubling down. And you also can't expect to get all your money back in one shot. So you can ride these things out, but you got to be aware of what your tolerance is, and you have to always leave room for it. And if you don't have the tolerance to basically double down twice and lose, not double down twice and guaranteed win, double down twice and maybe lose there too. If you can't afford that, don't start playing. If you can't do that, just keep tight stops and let it go when it fails. But let's see, flexible grid, yeah. So if we look at CL over here, so I think it was like 77.50 when we started, and then it went up on us, and then it came, you know, but it doesn't go straight up. It goes up, it goes down, and let's see, this is 79. This is almost 80, right? So we start at 750, it goes to 80, and so we double down there. So then it's I can't do the math. Once I used to be able to do this math. It's a 77.50 plus 80 divided by, oh, that's not right. D plus 80 divided by 2. So then you're at 78.75. So let's see if we can magnify this a little bit. Okay, so at 80, you double down, and now you're at 78.75. I think it was over here where we added. So it's 78.75 here. Then it comes back down to 78.75. You take it back off. Now your average is 78.75 on back to your original 1 or 2 or whatever shorts, you know, whatever your base amount is. Then it goes back up, and now it goes to 80.50 or whatever. So then you go plus 80.50, and then divide that by 2, and now we're at 79.62. So then it comes back down and we get back to 79.62 and we're out again. So now we're back to our base, but our base is now 79.62, even though we started at 77.50. So now we're up to 79.72. Then we try it again. Now, by the way, also though, when you're adding your double, if you're doubling down, you have to keep tight stops on the double down. So in other words, you double down at what you think is going to be the inflection point, and again, you use these pivot points. You say when it hits the top of the graph, when it hits this red zone up here, you figure it's a good time to double down. So when you double down though, if it goes over, you take it back off and take the loss on what you doubled down on. You don't just let it ride all the time. You know, so if it was going the wrong way significantly, we would take that off and we would try again the next time it looks like it's at an inflection point. But in this case, get off, get back to your original amount. Now it goes back up again. Okay, and we only had the one, so then we doubled down again when it hit 81.50. That was our next point to double down. But then so we had 81.50, 81.5, divide that by 2, and now our average is 80.50. So at 81.50, our average is 80. We didn't quite get back to it. This is where I got in trouble too. We didn't get back to it. So I added more when it hit 82. Well, I was looking for 82.50, but I ended up, you know, somewhere around here, I added more. And so then if, let's say it was 82.40 or 82.30. So then plus 82.30 divided by 2. Now the average is 81. Oh, that's what I said, 81.50. I was right. So the average was 81.50, and then finally, boom. But it's like a freaking Bronco. It's like if you can't ride it out, you're gonna just be disqualified in the middle. It's like riding a bucking Bronco. It goes up and down and up and down. But as long as you get that $1 or 50-cent move down, you can improve your net position. All right, but on the whole, that's it. And that's why I said today, I said, take the freaking money. It's like first of all, the report was a draw of 17 million barrels. The thing about that is on the EIA, oh, we can take a look at that now. The thing about 17 million barrels on the EIA is how the hell did that happen? How did we have a 17 million barrel draw in 1 week? That's an entire day's consumption in a week. What the hell happened? So that's a good thing to look at now. Can all these tabs possibly be relevant? Look how many of these there are. God, you know, I'm scared to close that because we had trouble starting it up. Let's see. 8.2, 8.2, and 8.2. Oh, well. All right. Anyway, so I'll open another tab. I got to clean all these tabs up. Petroleum status report. So 1 p.m. PDF, July 28th. That makes sense. Okay. Oil imports average 6.7 million increase, blah, blah, blah. Past 4 weeks, oil imports average 6.5, 2.3% less. Gasoline imports average 900,000 barrels. U.S. commercial crude inventories. Oh, let me make that bigger if I can. I don't know if I can because where's my little plus sign? Oh, this thing's blocking it. There we go. Okay. Commercial crude inventories decreased by 17 million barrels from the previous week. Okay. The inventories are 1% below the average for one thing. That's so not significant, but where the hell did they go? Total gasoline inventories increased by 1.5 and are 6% below the normal. Gasoline, finished gasoline, blended, blah, blah, blah. Distillate fuel decreased by 8 and are about 15% below the average. So we're very short on distillates, which is going to be a problem coming into the winter. Propane increased 2.9 million barrels. I don't usually care about propane, but where that, you know, where'd 17 million barrels go? Like that's our daily consumption, but that includes what we export. First of all, look how exports jumped up. They were, wow. Actually, look how exports have been jumping up continuously anyway. Last year, we exported 4 million barrels a day. Now we're exporting 4.4. Now it's 4.6 million barrels a day. So we're exporting 4.6 times 7, 32.2 million barrels a day is what we're exporting in petroleum products. 32, and our total consumption is 20. So it's more than a day and a half's worth of our consumption is being exported. That's insane. There's a draw in oil. Here's a build in gasoline. Here is a flat distillate. Here is a build in all other oils. Aha. So there's a build in all other oils and no change in the strategic petroleum reserve. So what we have here is a 6 million build in other oils. That's always a trick they use to make it seem like it's oils disappearing, because there's no proper count for it. And you know, when you read these reports, they don't talk about all other oils, but that all other oils is 6 million barrels taken out of circulation. And then we got a +2 over here. So it's only +8 though. So you -17 and +8, that's crazy. It's still -9. Where the hell is this coming from? So last year oil was 101. Last week it was 77. This week it's 80.55. Gasoline is cheaper than it was last year too, but it's also up for the week. Oh, here's gasoline. That was crushing. So it was $4.19 last year, the wholesale price. Now it's $3.75, $3.56. It's up a lot from last week. This is kind of crazy. Whoa, I lost my screen. Anyway, so the weird thing is though, why is oil down? Oh, here we go. Okay, so see if Bing has any idea. Hey Bing, Microsoft Edge closed unexpectedly. Sure, restore. Wait, no, go away. I don't care about that. Restore this. These are my chats. Certainly don't care about that. Certainly don't care about that. Where is my freaking chat? There it is. Thank you. We're up. We're down 17 million barrels today. August 2, 2023, but the price of oil fell how much? Do we have a percentage on this? 2.5%. 2.5%. Can you see any reason this might be happening? Because I don't have a good answer for this, so I figure I'll just take a stab at seeing what he comes up with. He's getting a bullshit general thing. Economic growth, one of the biggest factors, blah, blah, blah. One of the major sources of supply. OPEC, blah, blah, blah. This is very generic. Oh, come on. That's the best you're going to do? Totally not helpful. Okay. I mean, is there any specific news that has come out today that can explain why oil? Here's some stuff. Therefore, to answer your question, there could be several reasons. The market expected a bigger decline in inventories than was reported, which is interesting because how can you have a bigger decline in 17 million barrels? which disappointingly, although net 9 million, but still. The market anticipated a rise in production from OPEC or shale, which increased. The market anticipated, well, that's an iffy thing. He's just making stuff up. The market foresaw a slowdown of economic growth that we're seeing. You know what the problem is with these chatbots? They're so hung up on COVID. It was because it was so much the news when these things were trained. Like ChatGPT is trained up to September of 2021. Everything was COVID. And so they've got so much overwhelming recent news in the database of COVID that it like weighs into almost every single thing they talk about, which is, you know, and there's a big difference between humans and AI, because, you know, we understand that we put COVID in a box now and it's behind us, hopefully behind us, but it's in a box and we don't sit there and say, oh, well, because of COVID, because of this. You know, these things constantly talk about COVID. The market reacted to some other geopolitical environment. These are just, okay. Is there any specific news come out today to explain why? Well, went lower. Something you actually see in today. See, you think it's easy talking to these guys, but it's not. Oil prices resumed to rally. Well, that's wrong. Pointing to a huge drawdown in inventories, adding signals that the market is tightening. However, the article also mentioned the market is still facing demand concerns elsewhere, such as China. We know about that. India, where COVID is rising slightly. I don't know if that's true at all. According to Bloomberg, when? And you know, it's funny, like he says, according to Bloomberg, this is what's really, you got to be very careful with these chatbots, because it says, according to Bloomberg, and it'll cite the article, which I hopefully have opened. I don't know where it went. Oh, I opened it in a new tab. So Bloomberg article, August 1st, right? Do you think this thing says anything about COVID in India? Let's see. Well, oh, it's not going to let me freaking I do subscribe to Bloomberg. It just doesn't know it on this machine. What if I open it in a private window? Is that going to work? Because then it won't have an ad blocker. Come on, Bloomberg. By continuing, yes, I accept, yes. Yes, yes, yes. Oh, for God's sakes. Not gonna let me read it. Anyway, I will tell you that I'm fairly positive that if you read this article, it will not mention COVID, and I don't even think it probably mentions India. That's what happens. It starts talking, but then starts making shit up, which is very annoying. According to Kitco, gold and silver are down as the dollar rallied. Well, it's true, the dollar did rally. Let's give it that one. So if we look at DXY, how do I do this? No, it's going to be DXY without the thing. Is that going to be it? No. Charts. Star DXY. I mean $sign DXY. Okay, so how much of a rally did we get? We went from 102 to 103. It's only 1%. I mean, it's not really explaining it. Raised expectations for more hikes. A strong dollar makes oil more expensive for foreign buyers, reduces demand. Okay, I see that, because oil's priced in dollars. That's a logical point. Higher interest rates also tend to lower inflationary pressures and curb the appeal of commodities. Okay, so again, this is kind of based on the downgrade of the U.S. debt. People are panicking into dollars. The rising dollars hurts the demand for other countries where oil is priced in dollars, so therefore in their currencies it ends up being more expensive, and it can curb demand during critical summer months. So okay, I can take that. Oil prices rose 1% as the inventory showed robust demand. The article said the crude futures inventory from the EIA showed larger than expected decline in stockpiles, indicating strong consumption from the world's biggest fuel. However, oil prices are capped by worries that spread of the Delta variant of COVID. Oh my God, stop. There's some news articles I found. Okay. Well, thanks for not really the kind of help I wanted. So anyway, meanwhile, my question is, how can we have pulled, how could we have used, if you're only using, if we're using 20 million barrels a day, okay? But we export, you know, the 4.5 million of those barrels. So let's say, let's just take off 4. So we really use 16 million barrels a day of oil. And the rest is oil that we take in oil and we refine it and we send petroleum back to other countries. So that's why U.S. refineries make so much money. They're turning around other countries' products as well. So we're refining all this oil. I mean, we're taking in all this oil. We use, but historically we're always at the same thing. We always do use 20 million barrels a day. We export. You know, I'm pointing at the screen. That doesn't help you at all. We're you know, from last year 20, this year 20. That number doesn't change. So we're generally taking in 20 million barrels a day and sending out 4 million barrels a day. That's pretty normal. Now, it's normal, but it's completely messed up because it makes everybody think we consume more oil than we actually do. It's not for us, it's for other countries. So we're consuming 16 million barrels a day. But then if we're consuming 16 million barrels a day, how can you possibly use 17 million extra barrels in 1 week? That's an entire day's supply. That's 15% more driving or more whatever in one week. How? Not a week, I'm sorry, a month. How? Oh no, I'm sorry, it's not a month, it's a week. It's in a week. Yeah, so it's 50, but it's 15% increase in our total weekly consumption. What on earth could we possibly have done to cause that? So the number's wrong. This is the thing. And so knowing the number's wrong means we're probably going to get some backlash on the next report, because last month was suspiciously high also. Last week was suspiciously high also. But this is bonkers. This makes no sense. Where did it go? And that's the thing. Where it went is it went to some in-between space in the world of fake bookkeeping, where there's, for some reason, barrels are in transit or barrels weren't counted or whatever. But the bottom line is there's something wrong here. And just like anything else, there's a mean reversion. When you go that far to one side, it's almost certainly going to swing back. And so we'll probably have some unexplained build of oil or something like that. Or maybe there was some deal with the Strategic Petroleum Reserve to fill some up, but it's in between. In other words, like they could have purchased 10 million barrels, right? And the 10 million barrels haven't yet been logged back into the Strategic Petroleum Reserve. Therefore, everything's in transit and it's not being counted. So it's been, you know, so they took it off the books of some oil company and they didn't put it on the books of the SPR because it isn't there yet, right? So let's say Exxon had 10 million barrels to sell us and they took it off. And so Exxon took the money from the government, took the oil off their books. They're like, well, we got the money and we're transferring the oil to the government. But meanwhile, it's in transition. It doesn't immediately, you know, it's not like filling up your car. It's going to take weeks of tankers going back and forth to fill it up. But Exxon takes it off their book, and the Strategic Petroleum Reserve, since they haven't got the tankers yet, doesn't put it on their books. That's something that could explain what happened. But it's something like that. It is not that we suddenly all used 15% more fuel last week. That's just not even a thing. It wasn't even a holiday week. It was just a regular end of July week. Everybody was burning hot, but I don't think that's what I don't think that makes you get in your car and go on a road trip. You know, yeah, we use more air conditioning and stuff, but that's not oil driven. It just doesn't make much sense. Very strange stuff. So, you know, you can't take data at face value, and then, and frankly, the money is made by not taking data at face value. You know, but it's just so weird to see a 17 million barrel draw and oil drop $3. Yeah, it's not 2.5%. That's a lot more than 2.5%. Why does it say that? It dropped. Oh, it says it dropped $2. Oh, I see, because it went up first. So I guess from yesterday's close. From yesterday's close, but it spiked up overnight. Total head fake to squeeze everybody out, and then thank God I wasn't paying attention. I was at a dinner meeting. I would have been freaking out. What time is this? It's 8:04. Yeah, here you go. I was at a dinner meeting, so I wasn't in any way, shape, or form looking. And by the time I got home, it was like 10 o'clock, and we were back at 82. And I did look then, and I was like, ah, shit. And I was like, oh well, not much you can do about it, but hope it goes down. And thank God it did. So woohoo! So crazy. So meanwhile, today we reviewed our fabulous $700 a month portfolio. See how it's holding up. Whoop. Oh, yep, it's down to 12,306, and this morning it was, that's not it, home. That was last week. We did the Money Talk portfolio review. This week, it's the $700 a month portfolio review. 12,145. So actually, this is good. Good. I like to see that. 12,306. So it's 12,306, and it was 12,145 this morning. So we're in good shape. The percentage changed because we added the cash. So let's see. So the point of this portfolio, and we started 12 months ago. We started July or August 1st of last year. That's when we started. That's why this is the 12th month. But every single month right now is here. I guess I'll do it until it's such a ridiculous amount of things. But every single month is here. There's it's no extra work for me. I just add one thing each time and I copy the rest. But you can see exactly how we added every trade. I don't think, and I don't intend usually to trade other than the once a month that we do the portfolio review, which is the first week of the month. And the idea is that starting in week one, in month one, we put in $700, and then we said, oh, what are we going to buy with $700? So here we are. And again, 700, keep in mind, it's just a number. It doesn't mean anything. It's just, I decided $700 a month was an amount that I would very, very comfortably be able to say that we can get to $1 million in 30 years. So 30 years of savings, $700 a month. So in other words, anybody who's 30 years old could, I want to find an amount people could put together. So anybody who's 30 years old can take $700 a month and put it into an account and start building their wealth, and you will get, and we can get you to the point where you have at least $1 million when you're 60. And we talked about this in having a rate calculator, and I've done this before, so I'm not going to go over every aspect of it, but just very quickly, the concept is you put in $700, every month you add $700 more, so in addition, you're going to have $8,400. We said 30 years to grow at 8% will get you to $1 million. Now, our first year, I will show you this. So our first year, we're at 50%. So if you look at this and say, we start with $700, we put in $8,400 a year, and we give it 30 years, We are now at 50%. But let's say, let's say you're just at 20%. Let's say we perform at 20%. That's going to get you to $12 million. All right. So the difference between our minimum and again, 8% I'm saying is like, that's the market average, right? So you should be able to make 8%, no problem. 20% is not even our averages in our portfolios are usually much higher than that. I mean, right now we're at 50%. So imagine 50%, that's billion. That's $4.5 billion if we continue at the rate we're doing now. I'm not promising that, but you got to understand that all you're putting in is $700 times 360 months. So your total contribution over 30 years is $252,000. The point of this is to make you understand for yourself, for your children. If you miss, nobody misses a window. There's never a window that you missed, really. You can actually catch up by just putting in if you have a retirement account now, let's say you're 50 years old now, and you have a $1 million retirement account, you can take 200,000 now and start it that way, and that changes the math to be $200,000, right? So you're catching up, and you're going to put another $10,000 a year in, let's say, and you're going to do that for 15 years at 20%, and that's going to be $4 million. Okay, and how much are you putting in? You're putting in 200,000 plus 15 times 12 times $10,000. I'm sorry, that's 10,000 a month. Yes, another 100,000 a year. That's 1.8 million plus 2. So you're going to no, something's wrong with that. Hang on, calculate. I did something wrong. No, I said annual addition. It's not 100,000 a year. It's annual addition, not monthly addition. So you're putting in 150,000 and in your annuals plus the 200,000 you start with. I actually done that in my head, 350. So you're putting in 350,000. It's going to turn into $3.9 million, $4 million, more than 10 times in 15 years. And all I'm saying is you take 20% of your retirement portfolio out of the piece of crap thing you're in now and put it into a market plan like this. So the monthly amounts are arbitrary. You can make it any monthly amount you want, and it's just going to change the math on how much you're going to make. And again, we're talking about 20%. You go to 50%, which we're not going to make 50% every year, $100 million, 200,000 now, $10,000 a year for the next 15 years. And you'll have $100 million at 50%. 50% is not something you count on for performance. I want to be very clear about that. We just happen to be having a good first year. But you have to understand how realistic and simple and basic this is. And the point of this portfolio is to show you option strategies and how we work them and how it works out over time and how little you have to do. You just have to have the discipline to save and invest. And the market, as you know, in March it crashed and then it came back, and we never changed that strategy. We don't do emergency moves in this portfolio unless something absolutely tragic happens, which I don't think it has. And it's all we do is at the beginning of the month, we take another $700, we put it into the account, and then we spend what we feel like is worth it at the end of the month. So in our first month, what did we add? No, that's some old portfolio I'm talking about. Shit. Oh, that was our play. So I'm sorry. So I was looking at the old income portfolio, and what did we do? So we bought some shares of AT&T, 20 shares for $360. That's what we did with our $700 first month. We bought 20 shares of AT&T, and we bought 50 shares of NLY. That's what we did our first month, and that was August of last year or something like that. No, yeah, July, August, right? 50 shares of NLY for 3, what do they do, a reverse or something? They must have done a reverse since then, otherwise that wouldn't make any sense. And so whatever, and we worked it out. But then you can see every move and every change we make and what we did. So what's our plan? We accumulate 500 shares. Our goal was to get to 500 shares. Now notice what happened, it dropped. We got to our share count, then we sold calls, then we sold puts, and it all ended up working out for us in the end. And we've already cashed that out. We cashed out NOY and we cashed out AT&T. I don't know if we have AT&T's chart. Yeah. So AT&T, the same thing. In August last year, we decided to buy AT&T. It went lower. We bought more. It went back up. We cashed out. And if you go month by month by month, you'll see exactly what we did and why every single time. And it's just very simple. And so think about what we did. We started with $700, making moves like that. Very simple. Buy a few shares of AT&T, buy a few shares of that. Couldn't do much with the stock because couldn't do much with the options because we didn't have enough money. We didn't have any margin. We have no margin power. And we didn't have any cash, so we had to wait until we accumulated 100 shares of AT&T before we could even sell an option. Very frustrating. But that's the point. The point is, even with both hands tied behind our back, we made 50% in our first year. Starting off with nothing. And not shooting for the moon kind of plays, and certainly not in perfect conditions. We had that big dip last fall, went back up, had another big dip in March this year. It's a very uneven, crappy year overall for investing. Or I'm sorry, the segment of the year, starting from when we started in August. But we don't care. We just keep planting trees, which goes back to that video I used to like to show you guys, was the man who planted trees. Everybody who is listening to me should watch this, if you haven't already. For God's sakes, the man who planted trees. See, Google knows what I mean. The man who planted trees. It's this one that looks like that. It's all right. Well, they're probably all fine, but the point of this video is that this one guy comes back from the war, and I mean, it's not, I'd say I don't want to ruin it for you, but it's just a parable. But the point is, it's a guy comes back from the war, the German forests are destroyed, or the French forests are destroyed, or whatever, from the war, and it's just barren wasteland. And nobody lives there anymore, and this village that he used to like is gone. And he decides that he is going to replant the forest. And every day he wakes up and every day he plants 100 trees. You know? And these trees take years to grow. But every day he sits down, he gets his seeds, he puts them on the table, he picks out the ones that look the best, and he plants 100 trees, times 365 days, times 30 years, 1 million trees. Just because he keeps doing it day after day after day. And by the way, if you save $100 a day, the same way, you will have $1 million. If you save $100 a day for 30 years, that's how much money you'll have, $1 million. So it's a very beautiful, well done cartoon anyway. It's worth it to watch for the nuances of the thing. But the point is very simple though. Steady, slow and steady wins the race. You keep going, you have a plan, you stick to your plan. Yeah, some years his trees or his seedlings get wiped out, there's a fire, there's a storm, there's a flood, blah, 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 blah. Things happen. But he just gets up in the morning and he plants another 100, and some take root and some don't take root. But when you plant 1 million trees, it's incredible. I mean, you know, I mean, count how many trees you have in your county, in the metro area where you live. Are there 1 million trees? No, You're talking about a very substantial amount of trees covering a huge, miles and miles of land. Planting an entire forest that looks fully grown after 30 years, because the oldest trees are 30 years old, and then you've got 10 years of that. So 1/3 of your trees are 20 to 30 years old. They're already serious trees. And that's all this is. At the core, that's what our strategy is. We just keep going and we keep making those 700 here, 700 here, 700 here. So far this year, we're up to $8,400, or as of today, we just put in the extra $8,400. And we made 57%. Not only that though, but we've got hedges to lock in our now because we've made enough money, we started hedging and in fact, we spent half of our gains from last month on the hedges. Why? Because of what just happened today. Because it's what we expect to happen at some point. We're gonna have a substantial fall in the NASDAQ, and we're gonna want to be protected from that because we don't want to lose the 50% we made. And this is not a portfolio we are going to cash out. This is a portfolio that we intend to run through good and bad conditions in the market for 360 months. All right, it's unfortunately 30 years from now, it'll be like, oh yeah, but I frankly, I think we can get to $1 million way faster than that. Obviously. Oh, I took the calculator away. Shit. What did I do? I took it away from the first month review. Yep. All right. Well, I don't care. Anyway, so obviously, from if you go back to the first one and test that calculator again, at 20%, we're going to have $1 million in 10 years. We're not going to need 20 years. I was being super conservative and saying we're only going to make 8%. The average market gains are 8.5% per year. So over the last 100 years, been 8.5% basically on average. So all I'm saying is you invest and it make 8.5%. So this is the number that I came up with, $700 a month at 8% would be enough to get us to our $1 million goal in 30 years. The thing is that you have to convince, and I wrote an article about this too. I think I wrote how to get rich slowly. There's a video on it too. Let's see. How to get rich slowly. Oh, come on. I hate it when I say something and then there's like 100 other people read articles with the same title. Videos. Seriously? Oh, I'm so annoyed. How to get rich slowly. Way to go. Let's see if I put my thing on it. PhilStockWorld. There you go. All right. So there's that. There's also an article on it. Oh, there it is. How to get rich slowly. So you can read it too. From 2014. So this is almost the 10th anniversary of me explaining this whole concept in this article. So do you want to, I did, this is a layout of the same thing. So 10 years after laying this out, we were actually doing the portfolio to track it. This shows you where you are, how much you're going to make, so on and so forth. But the main point I made here, which is very important, did I make it here or was it only in the video? All right, well, the more it comes across better in the video. But the point is, you have to have this mindset, and you got to get your kids into this mindset that, like, don't buy a $5 cup of Starbucks because that's going to cost you $500 in 30 years. If you would put the $5 into an investment instead of into your mouth, it comes out to $500 in 30 years. $1,000 trip, it's the same math, obviously. $1,000 trip is going to also go up 100 times. and it's going to be $100,000. You know, and God forbid you sit there. It seems so easy when you go to like rent an apartment and you say, oh, but the $4,500 apartment is so much nicer than the $4,000 apartment. But that $500 a month of additional rent, which is $6,000 a year, is costing you $600,000 a year in your retirement. Not 600, I'm 600,000 total, but it's costing you $600,000 in your retirement. Every year, $600,000, because you had to have that little extra space, or you had to have the thing that faces the water. You know, whatever it is you do. Same thing with a car. You got to realize the multiplication, it's 100 times. In 30 years, whatever you spend today, 100 times in 30 years. Whatever you save today, you get back 100 times in 30 years. And it's so hard to get your kids to understand it. You really have to do the math. So that compound rate calculator and things, you really got to get them to understand that that's so worth it. And it's the same thing with an IRA. I mean, when I had a company with a lot of employees, I would sit down and do this for them. I would do the math for them and show them. I'd be like, this is why you're doing this. This is why we're doing matching contributions. I'm like, you would be incredibly foolish not to do it. I try to get everybody to do it because it's so tragic to not save. And especially when you're dealing with young kids getting jobs, they don't think about it at all. And they're like, I'm not going to take 5% of my salary and put it away, blah, blah, blah. It's like, that's crazy thinking, especially when you get the tax break and you get the company matching amount and so on and so forth. To not take that money is ridiculous. It's real money. And again, that's bullshit money because it goes into ETFs and all you're going to get is your 8.5%. But even the 8.5% is going to get you to $1 million. This is $700 a month, not a week and not a day. It's $700 per month. That means every day you need to find $20 to save. That's where you basically are. Take $20 off your budget on a daily basis, and you'll be a millionaire. So that is the point of this portfolio, is to teach the discipline and to show how it actually works. This is not bullshit. We are 100 miles ahead of 8%. This is where we should be in 5 years. So if we can keep this up, if we can keep up this kind of level, you know, the sky's like I said, literally we're on a pace to be billionaires doing it like this, and we only have $12,000. So. But again, this is not normal. This is a very abnormal market. And of course, if the market keeps going up the way it's going and we become billionaires, you're going to need $1 billion to buy some Starbucks. You go into Starbucks and they'll be like, yeah, that's $80,000 for a latte. So something's got to give. This is an inflationary, very high moving environment, but still it doesn't matter because over the long haul, inflation is generally going to go back below 10%. It's obviously it's below 10% now, but I mean, even bad inflation generally can't sustain itself above 10%. So your 8% market gains will keep you up with inflation and hopefully exceed them. And if we can get any traction above 8%, we're going to be in fantastic shape when we're older. And like I said, if you started too late, you just have to make it up. You can use that compound rate calculator. It's an incredible tool. Once you get to playing with it, you can figure out what you need. And that means, what do you need to sacrifice? It means when you sell your home that you're sitting on now, so let's say you bought your home for $500,000 and now it's $1 million, right? And you've got mostly paid off, so you're going to pull $800,000 out at the closing. Don't take that $800,000 and go and buy $1 million home somewhere else. Don't buy a $800,000 home somewhere else. But get a $500,000 home and put the rest in the bank and make money so that for the rest of your life, you'll never have to worry about money again. It's hard. It's always hard to sacrifice. It's always hard to say, I don't need this, I don't need that. But what you do need, because we're all living longer now, is you do need a realistic plan for how you're going to have money when you're 90. I mean, let me tell you something. God forbid they cure cancer. I know it's a weird thing to say, but if they cure cancer, the average life expectancy in this country will be 85. If they figure out cardiac problems, the second leading cause of death is cardiac. If they figure out cardiac and they figure out cancer, we're going to all be 90 something. There'll be a country full of 90-year-old people. And what? With no money and no savings. People don't save. The average American has $49,000 in savings for retirement, and that includes the people who have billions. That's the average. The median is more like, 16,000. People have basically no retirement savings. That's tragic. And the government's not going to help you. There's not even going to be Social Security. That's the other thing. People think there's going to be Social Security. There's not going to be Social Security past 20 years from now. There's no saving this thing. Not unless you tax the crap out of everybody else. This is not going to be a fixable system. It's too far gone. We neglected it for too long, and it's not going to be fixable. But you can fix it by removing the cap. That would be the best way to fix it. It won't fix it, but it'll prolong it for another 20, 30 years. If you take away the cap, that's not, because you stop paying when you hit $100 and something thousand, you stop paying Social Security. If they took away that cap and then people who earn $100 million had to pay a proportionate amount of Social Security, that would be great. But that's never going to happen. A lot of things that would be great are never going to happen. I'm not going to worry about that. But anyway, so AT&T, so our original trades are both gone. We don't have AT&T anymore, and we don't have NLY. We don't have NLY anymore, but we have CIM, who's a sister company. We traded in for CIM, and that worked out well for us. So we cashed out NLY, we cashed out AT&T, and now we have a whole new lineup. So over the course of a year, the first ones are gone, as they should be, though. You got to rotate out. If something's not performing, you rotate it out. If something is overperforming, you rotate it out. Get a fresh horse. So what do we have left? We have SunPower. And again, is it risky? They've been performing poorly. Why is SunPower the first? Oh, I see. What we did last month is we bought back the short calls on the spread. So it was a 10-15 spread or something like that. We bought back the short calls because they were up considerably, and we were going to sell more calls when SunPower went up. It didn't go up, but it actually kind of round tripped because it's back to 987. It went lower for a bit and then it went back. So now basically it's still where we are. So now I'm saying, okay, you know what, screw it. So now we're going to sell 5 of the 15 calls for 170, and we're rolling the $10 calls to the $5 calls. So we're taking the $10 calls we have, rolling them lower in strike. So instead of being more aggressive, we're being more conservative. We're rolling our 10s to the 5s, and we're selling the 15s to help pay for it. So now we have a 5-15 spread, 5 units. So if all goes well, that could be a $5,000 spread. I'm sorry, no, 5-15 spread? Yeah. Okay, I'm sorry, it's a 5-15 spread. So yeah, so it's a $5,000 spread. I may have underestimated this. Oh no, I didn't underestimate it. So we spent $462 total dollars on this transaction, and we pushed out $5 calls, $4 into the money. That's how you do it. So in other words, you have to be realistic and reassess and say, okay, fine, I still like SunPower, but I don't, but there's no point in saying I like SunPower and I have $10 calls at a 100% premium. I never want to see that. We had it for a little while because we thought they'd go up, and they did go up. At the beginning of July, I said SunPower is going to go up. It went up to 12 something. We unfortunately did not cover it because I'm trying to only make changes during the, on the days that we do it. But unfortunately, we went up, spiked all the way up to like 1250 or something like that. Then it went back down. Now it's back where we started. Now it's going to, eventually it'll spike up again. But I can't now. It's irresponsible of me to leave them nakedly open when they're all premium. So I thought we'd be able to cover at a higher price. It turns out we now have to cover at the same price we would have covered last month. Then we've got CIM. We're just waiting for those puts to expire. We sold puts on those. Future Fuel. I love Future Fuel. They're doing well now, so that's good. Barclays is one of the banks that we thought would survive. This is not encouraging today, so we'll see what happens. But again, I'm not going to take an action because the whole market's down and Barclays went down. Ford is another one. I don't understand how it's so undervalued. It's just crazy. My overriding theory on Ford is, and again, it's hard to believe Tesla. He's so full of crap, that guy. It's like hard to think who knows if he's telling the truth or not about his margins or anything. But for whatever, Tesla seems to have much better margins making electric cars than the major companies do on internal combustion engines. And it makes some sense. I mean, you're selling a car, it clearly has very, very few components. It's like a Hot Wheels car. It's got the base that's got the battery and the wheels and the battery makes the wheels turn. There's really no parts. It's like batteries, wheels, whatever mechanism is in there that makes them spin, and that's it. Obviously, I'm not a car guy, but that's a lot better than the 500 parts of an engine when you have to take it apart. It's not as complicated, it's easier, and you just basically snap a body on the base, and there's your car. Good to go. Just like the old Hot Wheels, right? You could change the, when you have the kind of Hot Wheels that would go on the track, you could take off the top and put a new top on, and it's just snap on. Which I don't know why Tesla doesn't do that more, because it seems like, you could have like all kinds of cool different looks. Although again, aerodynamics and all that, I guess. But anyway, so the thing is, if Ford starts making more electric cars, you would think that they will start making more profit than they're making now. Now, they have had problems with the recall of the F-150. That's what's been knocking them down. It'll pass. They'll fix it. It'll go. They'll sell more cars. It's hugely popular. And here's GoPro. We just added them. I think they're bottoming at 4. I could be wrong. Here's SoFi, and they're consolidating to move higher, so I'm not worried about them. That's our hedge, is the SQQs, which just jumped $1 today. And here's Trox, which is not doing well because of economic concerns. And we just added Nokia because, again, $4 is, you're getting down to a level where it's like silly not to buy it. Here's the thing, it's at $4. So I'm like, okay, I'll buy it for $3.50. So I'm going to sell the $4 puts for 50 cents. I'm also going to, since I have this $1,000, I'm going to spend $1,200 on the $3 calls, and I'm going to collect another $300 for the $5 calls. So I've got a 3-5 spread. It's $2 times 1,000. It's $2,000. It's a $2,000 spread. It's an $80 credit. So above 5, we make $2,080. At 4, which is where it is now, we make $1,080. We didn't spend any money to have the spread. Our net was an $80 credit in our pocket. So really, we're going to be assigned 2 calls. So as long as it's over like 325, we're going to make money because we have the $3 call. So at 325, our 10 calls will be worth $250, but we will have lost $200. Yeah, right about 325. So we'd lose $200 on the short puts, or basically that's our break even, 250 or whatever. It's just, yeah, that's about basically our break even. We lose 250 on the puts and we make 250 on the calls at 325. So this spread, as long as Nokia is over 325, we make money. All right, and this is the 350 line, not the 325 line. This is 350. Look what happened here. So last year in March, that's where we bounced. That not just bounced, but took off because people started plowing back into the stock. Right now, it's hugely out of favor again. It was hugely out of favor back here too. Look at, see that buying chart? So whoever was the big buyer here that jumped in and took a huge amount of it against some major selling pressure, they called this bottom. See, and that's what a buy program is. This is the 5% rule kicking in, right? You hit this line, the buy bots come in, they bought up, everybody who wanted to sell got bought up here. Then it went up, then it went down. They obviously got their fill at this point, so they weren't still buying. We went down a bit more. More people are still getting out because they took a huge hit from wherever it was. More people are getting out, but in the end, this line became very good support because a major buyer declared that to be their value line, 450. We're shooting for 5. So these are not reach for the sky kind of trades, but this trade returns 2,600% back on the cash. And it's not even really cash, it's an $8 credit. But you make 2,600% on this trade. That's how you get a portfolio up 50%. And it's not a trick because I said, if you count the money that we have no margin in this account, so it's going to be a full $1,000 of cash we can't use, right? And less the 80, so we're tying up $920 in net cash and margin. And the upside then is still 226%. And that's in 18 months. So you don't have to pick these crazy, you don't have to pick these trades and expect these great returns or anything like that. We're saying we think Nokia will go up $1, which is 25% in 18 months. If it doesn't go up 25% at $4, we're still going to make a ton of money. Still going to make $1,000 at $4, $1,080. And it's a very conservative trade. It's a very safe trade. We have. It has to go below 325 for us to lose. And you know what? If it goes to 325 in 18 months and we have nothing, we sell more puts and calls and our net goes down to 250. That's how this works. What doesn't work, and we talked about this today with a couple of trade adjustments, what doesn't work is shooting for the stars and betting something's going to go up 20-30% and taking ridiculous risks when you don't have to. I don't want to take a risk, and I sure don't want to take a risk when I'm in a portfolio build when I'm building a retirement portfolio. I absolutely don't want to take a risk. So what do we have? We're covering SunPower. We sold puts here, and so what I said is we collected $1.60 for a $5 put, which is a great deal. That would net us in for 320. Is that right? No, 340. So that would net us in for 340. So our worst case scenario was netting in at 340 on this spread, which we absolutely, and then we would sell puts, more calls, right? Then we would start selling calls. But right now I'm saying, okay, I'm willing to promise to buy $1,000 worth of CIM. You're going to give me $320 for making that promise. So now my net is 680, and I'm collecting 320 up front. I don't even have to wait for it. I get 320 now, divided by my risk, which is 680, which means I have to own 200 shares of CIM. So I'm getting 47%. We did this on November, and that's for the 2025. So for 2 years at the time. So well, let's see for sure where CIM was back then. So this was what, November 3rd of 2022. So in November of 2022, oh, again, another reverse split. This isn't, oh no, here they are. Sorry, here they are. So they were at $6, where it is now. So the stock was at $6, and we promised to buy 200 shares for $5. And they paid us $320 to make that promise. So our worst case scenario would be owning 200 shares at net 360. That's our worst case, 360 when it was at 6. So almost 50% below the current price. Let's call it 40% below the current price. So our worst case is we own the stock for 40% below the current price. And our best case is we get to keep the 320 without doing anything. So that's our 47% upside. So here we are. We've already collected half of the upside. And it hasn't been 2 years. It's been well, I mean last November. It's been a while, but it's not even a year, and we're collecting half the money already in a 2-year play. This is how you invest, and this is how you play options to win. It's not for taking, well, it's not for taking risks. It really isn't. It's not meant to take risks. It's meant to do exactly what we're doing now, to just promise to buy something, to set a price and to keep it. It's more like futures trading if you do it properly. But you have to have a reason. I'm happy to own 200 shares of CIM. It's not a huge damage in my portfolio. And the way that works margin-wise is what happens is, you know, I still right now we have $1,000 count against the margin, right? So you can see that up here. See that 1,000? That's the only short put we have. So there's your $1,000 charge in margin. But the 320 goes into our cash. So the net margin ends up being $680. But that's our promise to buy. We've promised to spend $680, $700 a month portfolio. I can afford to promise that. So I'm taking 1 month allocation that I have, and I'm promising I'll buy CIM. But I'm also saying if I don't end up buying CIM, I'm going to make 47% for not buying it. Very conservative play, very nice profit, 27%. I know we made 50%. It doesn't seem like a lot, but we only planned on making 10%. So, you know, we wanted to just do better than 10%. That's the point. So 47% in 2 years was perfect. Future fuel, and that's the other thing. You can't get greedy just because you have success. You still have to focus on, you know, what actually makes money and what you can be sure of. Here's future fuel. This one was a ridiculously low margin. We did this to make 8%. In November, we bought future fuel for $9.10. We sold the 750 calls, lower than 9.10. You know, I mean, so 750 minus 9.10 is 7.10. There's only a 40-cent spread on this thing. What we counted on was getting the dividends, which adds another 20 cents. So we're going to make about 10% between June and November. Which is what? Is that 6 months? It's more, you know, basically 6 months, 7 months. So in 7 months, we make whatever it worked out to. Let's say 10%. So we're going to make 10% in 7 months. That's great. That's what you do. Is it risky? How is it risky? It's certainly not risky owning stock. I bought the stock for $9.10 and I promised to sell it for $7.50. It's already at $9.10. I expect to collect the dividends, but if I get called away early, I don't care. I made my money. I made my 40 cents. That's half my profit already. The guy can call me away anytime he wants to. I can make 40 cents on a $7 investment every 6 months. What is 40 cents? $5.6%. So basically 10% a year. But again, this is a teaching portfolio. There's different strategies here, and the idea is to learn how all these different ways you can make conservative investments that still have great payoffs. Here's Barclays. We took the 7.10 spread, and Barclays is now about $8. And again, we took this in July. We took it last week. Not last week, last month. So we took it last month. So Barclays, Barclay. Here they are. So last month they were basically here, and they're back to where they were on having a couple of bad days in the market. But I'm not that worried about Barclays. I think they're good, and if they actually go back to the March lows, we'll be probably looking to add to this position. If they go back to 650, Barclays was one of the banks we decided would survive a catastrophe. So the point being, we bought it at about this price, $7.75. We bought the $7. This is aggressive for this portfolio because we didn't cover it fully. We bought the $7 calls for $800. We sold the $10 calls for $150. So we're in for $650, and it's a $1,500 spread. But also the plan was when Barclays made some big gains, which it made and lost already. So unfortunately, we didn't take it and run. I was hoping for like $9 plus. So, but if Barclays makes some more gains, we could sell the $2 calls. But meanwhile, let's say it doesn't. So here's Barclays, and we find annoying. Can I move that? I don't know what to do here. Where's my little elevator? Uh-oh. Oh, I see. That's because it goes to 2025. So even down here, we have the it was 710, right? So we have the 710. So let's say I sell 2 of these for $1.40. That's 280 bucks, right? Let's say I sell 2 of the 7 calls for 280. What am I doing? I'm going to take that money and I'm going to roll all 5 of my calls down for 140. So 5 times 140 is $700 to roll to the 5s, right? And then I'm going to sell 2 of the $7 calls. Oh, I'm sorry. So what did I say the price was? Damn it. It's 140 and this is 280. So let's see. So it's $1.40. So 5 times $1.40 minus the, what did we say this is going to be if we sell this? 280 minus 280. So then I'm fully covered and I spent $420, but for $420, what do we end up with? So if I added $420 to this spread, we end up with the 5-10 split on 7. That's $1,500 on 7. And we have 2 of the 7 of the 5 7s, and those would be $400. So now we have a $1,900 spread that we spent $420 on, plus what would be $650 that we originally spent, plus $650 is $1,070. So now we have a $830 upside. So let's try that. So it's 830 divided by 1070. So we still have a 77% upside potential if it gets to 10, even after it dips down on us. See, and more to the point though, if we have we then have the $5 calls. So as soon as we get that, as soon as we're back at 10, wait, we have 5. Oh no, I'm sorry, it's $2,500. That's right. So we have 5 of the calls. We only need to get $1,000 back to get even. So we only need to be at $7 to break even. So where we originally started the spread by adjusting it, rolling the 7s down to the 5s, selling 2 of the 7s to help pay for the roll, then the 5s, which are obviously well in the money, even at 7, we're going to break even on the trade. We're going to get $1,000 back. Over 7, we only have 2 covered at 7, then we have 3 covered at 10. So if it goes back over 7, we get our money back plus whatever bonus on 3 shares between $5 and $10. We can get up to $1,500 more on top of that. But do you see what we do? We retreat to a better position. If it goes against us, we have a plan to retreat to a better position, taking very, very little additional money to improve the spread and keep it in the money, because we're here to sell premium, not to buy it. So whenever one of our positions turns into a lot of premium, we want to do an adjustment. It's like, and if we're not willing to do that adjustment, we should take it off the table. If I'm not willing to spend $400 to do that with my Barclays position so that I can break even at 7, I must have lost all faith in the thing. I shouldn't be in it. Don't fool yourself on stocks. And the worst thing you can ever do is sit there and cross your fingers and say, I hope it comes back. That's a terrible way to be with stocks or options. So there's Ford, and notice Ford, it's a 12-15 spread. We're in that range already. We only spent net $750 on this spread. So 5 at 13.50 is break even. Our break even is 13.50 on the spread. There's absolutely no more risk to this than buying stock, except instead of buying stock, I spent $750 instead of spending $6,000 to buy the stock. And I have all the upside that 500 shares of stock would have given me, up to $15. GoPro, same thing. And again, it was too cheap. See, some of these you see, it's too cheap to ignore. Notice the prices in the $700 portfolio, right? The stocks themselves, not $6, $9, $7, $13, $4, $10, $17. You have to be conscious of, isn't that weird? Oh, that's SoFi, I'm sorry. You have to be conscious of what you can afford in your portfolio. You can't just decide you're going to buy a $25 stock or a $30 stock when you only have $700 a month to spend. So we are limited to looking for stocks that are reasonable to afford in this portfolio. And generally the cutoff is about 20 bucks. 30 is because it's the SQQs. So that's a specific hedge. I'm sorry, it's not at 30, it's at 17. But generally $20 is going to be our cutoff. We can't afford to be playing around with $30 and $40 and $50 stocks. We just can't afford it in this portfolio. So don't. And here's Trox. So again, these things, they get so low that it's not worth not playing. SoFi, we cashed out SoFi, our original trade, with a huge profit. And now we put this one on as sort of a, well, I don't want to feel bad if it keeps going up, so let's take this spread. This spread was very cheap. It's only a $500 net spread, and it's a $2,500 potential. So we can make $2,000 on that spread if SoFi keeps going up. If it doesn't, we only used $500 of like $3,000 of profit that we had on the original spread. We took, or maybe $2,500 of profit on the original spread. We said, okay, let's take 5 and leave it on the table, and that 5 could make another 2. So rather than just cash out the 25 and be done with it, we said, okay, we'll cash out this 25, but we still think 15 is a reasonable target. We just weren't going to leave 2,500 in profit on the table in pursuit of 15, but we don't mind leaving 500 on the table. So effectively, we took 2,000 off the table, left 5 on, and we still have 2,000 more of upside. Very, very minor changes that protect you and also give you upside. Protect you from a pullback and give you still upside. The SQQs we just doubled down on with our hedges. And Trox, again, like I said, there's another cheap one, $750 on a $2,500 spread that's in the money, $750. You see how all these, you see the commonality of all these spreads is they're in the money. We're buying effectively the stock. We're selling the premium. Any premium that's in our long calls, we are selling it to somebody else for the short calls. So we're paying no premium and establishing a stock position, but using 1/10 the money it would cost us to actually establish a stock position. Then UNG is basically on track. It's right about $7. They had a big pullback today. They're right about $7, and we're looking for 2025 $8, so really nothing to worry about here. This was only a $285 purchase, and it's a, what is that? $900 spread. So for $285, we bought a $900 spread, and we are currently, well, let's call that 2. So we're currently 6 in the money. So we've doubled. We're sitting on a double. Why does that not show that? Oh, because of the premium. That's right. So we're 6 in the money, but that doesn't matter because there's premiums. So you could still buy this spread for whatever that is, 1020 minus 756. So it's still $264, and it's still a $900 spread. So minus 900 divided by 636, it's 264. You still have a 240% upside potential, but even if it expires at 7, that's $600 back on your 293 or whatever it was. So you have a double if it just stays where it is. And if it goes up to where you think it's going to go at 8, you'll have a triple. That's how this works. There's no, yeah, options are risky for this idiot who's paying us what's the number? Paying $2.70 for, we're dumb too, except that we're dumb, but then we sell the premium back to this guy. He's this guy, and maybe he's selling premium to someone else, but who cares? He's paying $2.70. Now it's down to $2.52, but he paid $2.70 betting that UNG will be over $8, and it has to be $10.70 before he gets his freaking money back. That's idiotic. And that's why people tell you, oh, options, I lose all my money. Oh, I played options, they never work out. Yeah, of course they never work out because the odds are completely against you. That's why we sell options, we don't buy them. That's why we talk about be the house, not the gambler, the house. We are the casino. We are selling the options. Stock options are about the only thing in the world that I know of that lets you do this. You take the opposite side of the trader, but it's not like when you play craps and you get to play the opposite side, or when you play baccarat and you get to be the bank. You're because in those games, the house still has an edge on you because the house is running the game. But in options, it doesn't work that way. In options, you're taking the opposite side of the guy who's paying all the premium. You are the bank, you are the house. And that's why all this works. And that's why it acts like a cash machine. That's why we have these phenomenal profits. Because if you do it correctly and you minimize your risk, not maximize your risk, if you minimize your risk and maximize the risk of the guy you're selling options to, it works brilliantly. You only have to be pretty much right on the picks. That's the trick. But you could literally, I mean, this is where the real money comes in. So this is a money management aspect. We sell premium constantly. We have a tremendous advantage in every position we take. But then we need to be right. But we only actually have to be right 40% of the time, and we would make good money. But because we're pretty good at making picks too, we're right 60% of the time, sometimes more than 60% of the time. And that's when you start really banging it up. That's why these, we don't have, I don't think we've had more than 1 or 2 losing positions all year in this portfolio. And by not losing money, which is Warren Buffett's rule #1 of investing, don't lose money. By not losing money, we are able to take those odds that are stacked in our favor and multiply them over and over and over again until it becomes, ridiculous. 57% in a year is ridiculous. Like I showed you before, you would be a billionaire in 30 years easily, investing $700 a month. Not by putting all your money into NVIDIA or AMD or some other stupid thing. You don't need to do that. You just need to sensibly invest your money, and you've got a much better chance of being a billionaire than you do if you sit there and chase after some idiotic stock. We're not chasing anything. We're finding value stocks that are good buys. We take a conservative position and we use the options for leverage. But mostly we're using the options to sell the premium so that we know for sure we're going to have money coming in. And then IVZ was the month before last that we added this one. And again, this one was aggressive and it's paying off so far. We're up about 120 bucks. And this is a, this was a weird one. Yeah. We took the 17 calls because we didn't actually, as you see, worked out. We took the 17 calls. We sold the 15 calls, but we only sold 3 of them, because we didn't think IVZ was really going to go anywhere. And so we're counting on the premium decay of these guys exceeding what we get. But even when it goes up, so in other words, we've got 5, they've got 3. As it happens, IVZ has gone up. If I can find it. I think I missed it. What happened here? Why is that? Did I forget to do it? Trucks, look here. Wow, I forgot to do them. I'm sorry. Somehow got distracted. So when we did half the trucks, I went straight to buying a new trade. I didn't do UNG or that. So anyway, so we had it was a weird thing, but the bottom line was we took an in the money call, or I'm sorry, we took an out of the money call, but we sold the 15 calls because they had a lot of premium, and we expected the net decay would work out in our favor, and it does so far. So here we have a big time advantage. We sold the October 15 calls. They're going to expire. We sold them for $1.85, so that's $16.85. We're at $16.83, but they're losing their premium. But IVZ went up. Let's see if we got a chart of that. Yeah, here we go. So we bought these in June. IVZ went up, and our long calls gained a lot in option price because it seems like now they might do better. So projections are getting higher for them. But the short calls are October. So for October, if it doesn't keep going up, those October calls are going to be worthless. So the premium of the October calls is wearing out faster, and our long calls keep their premium and get more premium, in fact, as we move a little bit higher in strike. So it's a little complicated, but again, the point is to teach various strategies, and I'm going to fix that. I'm going to add UNG and IVZ later. So the point is to teach all these various option strategies, and if you want to find what we did with IVZ and Y, you just go to 6/8. That's 2 months ago. So that should, wait, last month and 2 months ago, I think. Yep. And you can see what our logic was. So when we added it, and by the way, notice all these stocks that we were following. We've now exhausted our list of stocks, but these were ones we intended to add if things turned out right. We added and subtracted BBAR already. It took off fast. BTG we decided not to do. Nokia we finally added today. GSL I'm still tentative with the shipping thing. Barclays we ended up adding. Ford we ended up adding. Future Fuel we ended up adding. PBR didn't come back down, so we didn't add it, or it took off before we added it and we gave up. Trox we decided we added it. PRVG doesn't have options, so we gave up on them. So Future Fuel, Babar, IVZ. So I said we still have $12.99 in buying power back then, and I'm going to show you another stupid options trick. That's what I said at the time. It's very undervalued, but the sector is uncertain, so let's do the following. We do 517 calls, we sell that. So here we're using 410 in cash. We'll be charged $600 in margin for the 3 calls that are not covered. For $2 of potential gains, but the reality is we bought $950 of we bought $950 of 590-day premium, and we sold $240 of 135-day premium. So we bought premium that is going to lose 161 a day, and we sold premium that's going to lose 177 a day. So we make 10 cents a day. But that's 10 cents times 500 is $50 a day. So just by playing the premiums off each other, whether it goes up or down, we get $50 a day. That sounds like too much. IVZ is 16, 161 a day. Oh no, I'm sorry, that's the actual amount. So it's not times 500. That's what we're making total. So our premium, so we sold 161, we bought 161 a day of premium, and we sold 177 a day of premium. So they're going to lose their premium faster, but it's so every month we're going to catch up on them, and that's what's been happening. And the stock went up. That worked out in our favor. So I said, so we're covering our own premium decay, and the $20 calls are 105, and so that's our roll. We even have the roll plan. So eventually, if IVZ keeps going up, which it did not so far, but this was back in June, don't forget. So if IVZ keeps going up, we're going to take these 3 calls, short calls, we're going to roll them to a higher strike. Meanwhile, if that's happening, our longs are getting deeper and deeper in the money. And we only spent $410 for the spread. So we've got the 17 calls for $410. We're going to roll these along. We can always roll them from 3 to 5 and roll them even higher. And so our very cheap $17 spread can turn into a $17.20 spread or $17.22 spread. But if it's a $17.20 spread, that's $1,500 for $410 in cash. We're using the premium decay against the person we're selling the options to. He's paying more premium than we are. It's like if I rent an apartment for $3,000 and I sell it to somebody else, give it to somebody else for $3,500 a month. I get $500 a month. As long as he doesn't default, I'm getting $3,500 a month. So as long as I pick decent stocks, I know I'm going to make money. I'm not guessing. And I'm not taking chances, and I'm not predicting any of my stocks. I think these are all great stocks. I'm not predicting any of them are going to make a ton of money. I'm not predicting they're going to go up 20%. I'm saying if they're basically flat from where they are now, we're going to make money. And why? Because we have premium decay in our favor, because we're selling the premium and we're collecting the rent every single month on every single stock. And that's how we build our wealth, just like any kind of landlord who starts renting houses and so on and so forth. And it's just like the casino model, that we open up another game and another game and another game. And the more games we have and the bigger the casino is, the more likely the statistics are going to line up the way they're supposed to. You know, if you're running a roulette wheel, okay, you could end up having 3, 4, 5 players in a row hit a number, and you have to pay them 35 to 1. So you can go broke running a one, or, you know, even though the odds of roulette are the same no matter where you open up a table, you can go broke because these 5 times in a row, your particular wheel, the people had bet on your wheel, and you never anticipated that could happen 5 times in a row, and you're not collecting enough money to cover the bets. But if you have 100 roulette wheels, the chances of the odds going against you at that level are astronomically slim. And all you have to do is keep playing and keep letting people play roulette, and eventually the math is going to line up with the actual results. The more games you play, the better your odds. So you don't put all your eggs in one basket. We don't put all our stocks in one sector. We diversify, and we keep our allocations at a small amount, so there's no one particular thing that gets unlucky that can kill us. And we keep cash on the side so that we can make adjustments and take advantage of situations. That's what this is all about. So in a nutshell, this is probably the most valuable portfolio review for you to read and to really understand exactly how we're trading, exactly what we're doing. Oh, I like that one. I should use that again. I like that. What did I use? I don't think. Oh, I see. I put the portfolio up like that. Haha. I like the duck. Anyway, but you know, if you want to really understand our trading style, how we make adjustments and what we do and how we follow through trades, this, you know, this is the way to go. Don't be thrown off if you're a big time trader. Don't be thrown off by the fact that it's a $700 a month portfolio. You can do this for $700,000 a month. You know, if you open up a hedge fund, well, if you opened up a hedge fund and you put in $7 million a month into this portfolio, you'd be up 57% right now. You'd have $12 million or whatever, $120 million, I guess it would be. Because that's the way it works. It's a matter of putting things in proportion and making sure you allocate your resources. And that's another discipline, by the way, because we're doing $700 a month. We're generally allocating no more than $1,000 to any given position. And that's also a very, very important discipline to have. So after 1 year, we've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 positions, or 9 positions in our SQQ hedge, frankly, but we have 10 positions after a year, and they're all in that range of, generally about $400 to $1,000 in range. And we've got the cash. This only took 1 year, and people are so impatient. Even the new portfolios we only started our new portfolios in May. This one was earlier. This was from last year, but the new portfolio, this was a new portfolio last year when we still have the old portfolios. Now we have brand new portfolios started in May, which is only 3 months ago, not even 3 months ago. And of course, it takes time to build them up, as this took time to build it up, but it's the same strategy also. It's the same thing. We pick a stock by stock and we diversify and we sell lots of premium and we don't take crazy chances. When we're up 200%, we take crazy chances. And I know that's a transition for people who came in late on our last set of portfolios because we were up so much. We were up 300, 500% in some of these portfolios. So yeah, we were happy to throw, $50,000 at something and see if it worked because we were up, hundreds of thousands of dollars. But that's not what you do when you're starting a new portfolio. In a new portfolio, until you're ahead, you never take chances. You get ahead, you get comfortable, you've got to be ahead of your goal, and then you can take some of the money that you're ahead of your goal with and take a few long shots. But you never take a long shot in a starting portfolio. It's just a really bad idea. All right, anyway, as the voice fades out, thanks everybody for coming. I appreciate it. We'll see if you have any quick questions before we go. Dave says, can you clarify the short puts? Two $4 puts gives us $100, not $1,000. Where was that? Two $4 puts gives us $100. What do you think he was referring to? Is that on our new trade? It must be our new trade. What do we add today? Maybe I did something wrong. Two $4 puts for 50. Oh, it's $100, not $1,000. Is that right? So two, yeah, obviously it's $100, not $1,000. That's a big difference. So that changes the numbers here. Sorry about that. You're right. I have to fix that. All right. Well, sorry about that. So this is not going to pay off as much as I thought, but it's still obviously perfectly reliable trade. In fact, it is 1220 minus 400 is $820 on the $2,000 spread. So it's 820, not whatever the heck we said, not $80 credit because of the difference in the puts. All right, well, thanks for clearing that up, guys. I got to fix that as soon as possible to make sure we have it accurate. But meanwhile, obviously, when we put it into the portfolio, it's accurate because the portfolio machine is not going to make the same mistake. All right, anyway, so thanks for coming, everybody, and see you again next week. Take care.